welcome to my channel today. This is the King's Tutor. It's the first time of joining us. Thank you for clicking to this. Ensure you like, comment, share, and subscribe to this channel. Okay, and if you're a returning subscriber, thank you very much for your support thus far. Now, today we want to continue our series on partnership. We have seen various videos from the introduction of partnership, to the admission of a partner, to the goodwill, to revaluation of partnership, and now we want to see dissolution of a partnership. Okay, now if you have not seen all this video, I'll drop them here, and I'll also check in the description for more, so that you can have a knowledge of where we started from. Okay, now what is dissolution of partnership? Now, dissolution, from the word dissolute, it means coming to an end of a partnership with agreement. That is when you come, when the partnership business comes to an end. That means when it ceases to exist. It's what we mean by what? Dissolution of what? A partnership agreement. Okay, so that is when a partnership comes to an end. You said the word dissolved, the partnership. So in terms of partnership account, we call it dissolution of what? A partnership. That is the coming to an end of what? A partnership business. Okay, or a partnership with agreement. Now, there are many reasons why a partnership might come to an end. We're going to be seeing many of the reasons. Okay, now one of it is bankruptcy of a partner. Now, when a partner is declared bankrupt, it can lead to what? End to the partnership business. Okay, so that's one of it. Two, when a partner dies. Now we're looking at the reasons for dissolution. Okay, what are the reasons for dissolution? Two is what? When a partner dies. Now, when a partner dies, and more so if it's an active partner, it may lead to what? An end of that business, because the active partner is such that is a partner that knows more of the business, takes active part. So when a partner that is active dies, it may lead to what? An end of that what? Partnership what? Business. Okay, now the third one, when the time fixed for the agreement has expired. When the time fixed for the agreement has expired. Now, this arises when probably in a situation when they fix that, okay, this partnership business is to achieve a certain goal. Okay, if they get toward achieving a certain goal, definitely if they meet that goal, they might cease to exist. Okay, that's another reason. When the time fixed, or they said they are staying for 2 years, 3 years, 4 years, 5 years. So when the time fixed for the agreement, when it elapses, they might decide to cease to exist. Okay, another one is for a joint decision to discontinue. That's when all the partners collectively agree. That's okay, let's come together. Let's discontinue this business. That's a joint decision. Okay. Another one is when a partner retires. When a partner retires, it can also lead to dissolution. Okay, we also saw that in terms of revaluation. That is why would they want to revalue their asset when a partner retires also. So another reasons that may come to an end of the business is when a partner retires, and more so if that partner, like I said before, is an active partner. Okay, so it can lead to dissolution. Another one is when the business is insolvent. When the business becomes insolvent, that means it doesn't have money to meet up to its short-term maturing obligation. They may decide to end the business. Okay, when the business is become insolvent, they may decide to end the business. Another one is consistency in experiencing loss. when the business continues to experience loss, they are not making profits. They are what? Incurring loss year in, year out. They may decide to what? End the business. Okay, so that is consistency in experiencing loss. Now, the eighth one is when a partner is declared insane. Okay, when a partner is declared insane, that means not sane. It means that he has run mad, he or she has run mad. Definitely, it may lead to what? An end of the what? The business. Okay, so the next one is when there is disagreement between the partners. When there is disagreement between the partners, it may lead to what? An end. A disagreement that cannot be resolved among the partner, it may lead to what? An end of the partnership business. Okay. Another one is when the business is declared illegal. When the business is declared illegal, that means they have ventured into some activities that is not legal. Okay, for instance, like pushing of hard drugs and some other item, they may decide to end it, and this might be forcefully. Okay, so that is when the business is declared illegal. The next one, on conversion to limited liability company. So another reason why a partnership business might dissolve is when it is being converted. Probably it has become too big that it can no longer be called a partnership, or it now becomes a company. So when it becomes a company, it ceases to exist as a partnership and transform to becoming a company. Okay, so when this happens, definitely they have to dissolve the partnership business and now revolve it to become a company. Okay, another one is on amalgamation to a bigger partnership. Now, amalgamation means the coming together of two formerly independent companies to form one big company. So amalgamation means merging. So when probably they merge with another company or another partnership that is bigger than theirs, it means that theirs with we cease to exist. Okay, so these are some of the reasons for the dissolution of a partnership. Okay, some of the reasons for the dissolution. Now, when a partnership is dissolved, there are some rules that have to be followed in order to ensure that the capital there, the profit there, the asset there will have to be distributed. Okay, and in order to ensure, because if they dissolve the partnership business, they have some assets. So definitely they have to sell some of the assets in order to get cash. If they are owing some creditors, they have to pay off their debts. Okay, they have to do that. So once they are ending the business, there are some rules that is supposed to be followed in order to ensure that end well. Okay, so some of the rules that they should follow suit are, as we call it, the rules for distribution of assets. Because when the partnership comes to an end, definitely the asset they have to share it among themselves. Okay, they have to either sell some, get some cash realized, pay off their debt, and will keep the remaining for themselves. Okay, and also if there's any partner that took more of the item in a business that necessitate that it brings cash to the business, definitely it has to bring. But this rule have to guide in terms of the distribution of these assets. Now the first one is all losses should be paid out of capital. As the first one, losses should be paid out of capital. Okay, so should in case that in their event of running the business, they have experienced loss over time. So losses should be paid out of what? Their capital. Okay, that is one of the what? The rules for distribution of assets. Now the second one is payment of debt and liabilities to outside creditors. Okay, now like we said, now once they've sold some of the asset, or if they still have cash remaining, they have to settle their debt and their liabilities to what? Creditor. That's the rule. You must settle the debt and the what? Liability that business is owing to outsiders. Okay, that's the second rule. Take note, because some exams they'll ask what are the rules for distribution of assets. Okay, now the third one, a payment of partner loan. A payment of partner loan. Now, if, for instance, there's a partner that gave in excess of the capital, that's the lender business, or give the business a loan, for them to boost their capital. Definitely, in the event of dissolution of asset, you have to pay the partner that loan back. Okay. Remember, in terms of the rules, the rules that the deeds of partnership that contains the agreement, we talked about that when the partner give in excess, okay, so it is termed with loan. So definitely, in the event for the rules for distribution of assets, if after they've paid toward the debt to outside creditor, definitely they must pay the partner the loan. Okay, so the fourth one is settlement of partners' capital. Now, if after they've settled all this, they still have cash, they will now have to settle partners' capital. Okay, pay up back the partners' capital, the money they use in investing in that business. You have to give it back to them. Okay, so that is the fourth one. Now, the fifth one is any profit should be shared in their profit or loss sharing ratio. Any profit should be shared in the profit or loss sharing ratio. Okay, now definitely they have if after doing all this they still have money remaining, it means they have profit. So the money should be shared in their profit or loss sharing ratio. Now these are the rules guiding the distribution of assets. Okay, now let's see the accounting entries that necessitates what we are going to debit and what we are going to credit. Okay, now we are going to see that now. So the accounting entries. So when dissolution happens, definitely some of the asset there might be sold. Okay, so what you want to do is to check the book value of the assets and the amount you're selling it to see if there is profit. Okay, so now the first one is open a realization account. Call it realization account because definitely if there is sales made, it is the cash shall be realized. That is how much was realized from the asset that has been sold. So we open an account we call a realization account. So I'll open it. I'll do it here. So if we have what we call realization account, at the debit side, you record the book value of the assets. What is their book value? Their cost value. Okay, so record book value of assets. Book value of assets. Okay, while the credit side, you record the cash realized. The cash realized when you sold or when the business sold the asset. The debit side, record book value. So that is what I want to say here. When we open the realization account, you debit the book value of assets except cash, and you credit their respective assets account. Okay, so you debit the book value of asset except cash. All the assets, their book value that was given in the balance sheet in the question, you debit it to the realization account except cash, while the corresponding credit entry will go to their individual asset account. For instance, if we have plant and machinery in the book value that was given, plant and machinery, if we have it here, let's say 2,000. If we have land and building 1,000. So once you've recorded the book value, now in their individual account, if it is asked to prepare, so open here, plants and machinery, will come here, call it realization 2,000. So you do the same for land and building, right? Land and building, you call it realization 2,000. So with that, you've done it. So if there are other assets except cash, their book value, you record your debit side of the realization account and you credit their individual asset account. Okay, that's the first one. Now the second one is you've opened and recognized the book value of the asset. The second one is when asset is sold. When asset is sold, remember we are distributing the asset. We are trying to sell some asset. When asset is being sold, now how do we record this? Now, if asset is being sold, it means we are selling it to get cash. Okay, so if we're selling to get cash, definitely you debit the cash / bank account because money is coming in. Then you credit the realization account. Okay, so you credit realization account. So for instance, if we have assets that was sold, for instance, we sold the plants and machinery for, let's say, 4,000. Okay, and we sold the land and building for 2,000, for instance. That's a cash realized. Okay, now the corresponding entry will come to the cash book. Corresponding entry will come to the cash book after you've written the balance brought forward. Now the balance brought forward will be the book value of the asset that was not here. So it will come here, the amount. Okay, then the plant and machinery, that's a cash realized. Okay, now the plant and machinery, you put the amount there, 4,000, and the land and building, you put the amount there, 2,000. Okay, so that is how you do it. Okay, when the asset is being sold. Now also the third part is assets taken over by partners. So when the asset is being taken over by partners, now most time they might not want to sell it to outsider if it's some asset that some of the partners might find valuable that they want to take. So how do we record this? Now we have to debit the partner's capital account in the column of the partner that took an asset, and also credit the realization account. Okay, so we are crediting realization account because it is also like a cash to realize, because definitely that amount will have to be deducted from that partner's share. Okay, so we'll just credit it here. Assets take over. So we'll put the name of the people. If it is OB, you put it there, the worth of the asset. If it is 3,000, if it is Kumasi, you put it there 2,000. So everything gives you 5,000. Okay, now you come to the capital account. So if you have a capital account, so you come to the capital account, for instance, now where you have the capital account, if you have OB and Kumasi, so you just write it there, which asset was taken over. The name of the asset, if it is motor van that was taken, so you debit it, motor van. OB is 3,000, you put it there 3,000, and Kumasi is 2,000. Okay, so that's how to record it when asset is being taken over by partners. Okay, so that's the third one. And the fourth one is any expenses on dissolution. Expenses on dissolution. Now, how do we do this? Now, you debit the realization account and you credit the cash / the bank account. Okay, so any expenses. Now they might want to get a liquidator, an individual that can value the asset, that can value the asset, know its worth. Now in the course of what the dissolution, there are some persons they might employ that is not part of the partnership. Definitely they will have to pay. So those expenses they incur in that period, we group them together. I will call it the cost of dissolution. So that cost of dissolution will be paid. So if it is paid, the cash is going out. So you have to credit the cash book. So you credit the cash book and you debit the realization account. So we'll just come here to the cash book and write cost of dissolution. Cost of dissolution. If it is 1,000, you put it there. And the corresponding entry comes to the realization account as the cost of dissolution also, or what we call dissolution cost. Okay, so we put it there, 1,000. Okay, so that is for the expenses on dissolution. Now the fifth one is pay off creditor, like when creditors are paid off in terms of the debts they owe to the creditor. So what do? You debit the creditor's account, debit creditors account, and you credit the cash account. Okay, the cash or the bank account. So the same way, if we have the creditor that we're owing, so you just come to the cash book and you write creditor. If it is in full, you put it there. If it is 1,000 also, and the corresponding entry comes to a creditor account. So you open a creditor account. If it's an individual creditor that his name is there, you put it there. The corresponding entry will come here, cash of 1,000. Okay, so that is for pay off of what creditor. Okay, so the next one is discount receive. Discount received from creditors. And the discount received from creditor. Now, how do we record this? Now, so you debit the creditor's account and you credit the realization account. Okay, so once they give discount by the creditor, what you have to do, you come to the creditor's account and you write it there, discount receive. If it is 500, Then you go to the realization account and you put it there. Discount receive 1,000. Okay, so now listen. Most time, a question might be tricky. Now, they might not state it outrightly that there's discount receive, but you have to check. Now, how do you check? Very important. Now, if you check in the balance sheet that was given in the question, and the creditors there is let's say 10,000. The creditor there is 10,000, and in the additional information they state that creditors was paid in full of 7,000. In the balance sheet, the creditors there is 10,000. In the additional information, they now say creditor was paid in full worth 7,000. What they are saying outrightly is that there is a discount of 3,000. Even if they didn't state it, but just by saying that they paid them in full 7,000. But in the balance sheet that was given, the creditor is 10,000. But they are saying that they paid them in full worth 7,000. It means 3,000 is discount received. So you have to apply it like this. Okay, debit the creditor's account with that amount, and you credit the realization account with that what discount received. Okay, now the next one. Okay, so this one will be 7. Pay off any loan due to a partner. Okay, so to pay off any loan due to a partner, what is the double entry? It's debit the loan account and credit the cash / the bank account. Okay, so when this arises, open up a loan account, you debit it, and you credit the cash, right, loan, which can be let's say 1,000. Okay, so that is in terms of this. Now once you're done, these are the transactions. Now once you're done, now we'll come to the realization account. We compare and contrast. Now if the credit side is bigger than the debit side, it means there is a profit. That is because the debit side comprises of what they receive, the cash they realize. Because if you check here, these are cash they realize from the sales of the item and also discount received, while the debit side is the book value and some expenses being made. Okay, so if the credit side is bigger than this, it means there's a profit. So you have to share the profits as regards their profit or loss sharing ratio and transfer it to the what? To their capital account, the same way we've done over time. Okay, but if the debit side is greater than this, than the credit side, it means there's a loss. You also have to share it in their profit or loss sharing ratio and transfer it to the debit side of the capital account. Okay, so for instance, if we check here now, this is 4, 6, this is 11, 12, this is 12,000, and this is 2, 3, 4. So 12,000 minus 4,000 will give us 8,000. Now let's take for instance their profit or loss sharing ratio is equal. So it means the share of profit for OB will be 4,000, while for Kumasi another 4,000. So that when you add together it is 8,000. Okay, so that's the share of profit because the credit side is greater than the debit side. Okay, this is an illustration. So if the share of profit for 4,000, because it is equally, now we'll transfer it to the capital account here. Now we can now have share of profit for OB is 4,000, for Kumasi is what? 4,000. Okay, so that's that. So also now you're going to check also the capital account. Okay, so from here now we're also going to check if any partner's capital account show the debit balance. It means that the partner will have to bring in cash. Okay, we have to bring in cash. The debit balance insinuates that his debit side is greater than the credit side. Remember, the credit side is what they receive. okay, what they receive in terms of what the business will have to pay them, okay, because this is where we'll get their share of profit. Now, why this is what they'll have to give, debit side is what they'll have to give to the partners, the partnership account. Now, in this situation now, if for instance any partner have a debit balance, it's insinuating that his debit side is greater than the credit side, okay, it means that he has to bring in cash. Okay. Now, if for instance you are balancing the account, now whatever is here, whatever becomes the balancing figure for the capital account must reflect what is at the cash book. Now let me repeat. For instance, if this is 4,000, now to balance this account now, we will now have what we call the balance carried down. That balance carried down is a cash. Okay, so to balance it up now, this will be 4,000. This will be 4,000. Now this is cash 1,000. This is cash 2,000. So that everything here will be 4,000, and this is 4,000. So this cash 1,000, 2,000 must reflect what should be here. If it doesn't, it means what you did was wrong. This is actually a check to know if what you did was correct, and also it will reflect the fact that the cash book will be paying those partners. Okay, you feel that the cash book will be paying those partners, so it will reflect cash 1,000, 2,000 here. So the balance for cash, to balance it up, also should be will be 1,000 and Kumasi 2,000. So with that now you can balance it up. Okay, with that, these are illustrations, so that's why it doesn't balance. So with that you can balance it up. So what am I saying in essence? That the balancing figure for here, for the capital account, should be the same for what the cash book. Okay, the balancing figure. So then you have to balance other individual accounts and asset account. Now, like I said before, if any partner's capital account show the debit balance, it means that he has to bring in what? Cash. Okay, so if he has to bring in cash in order to sort out the finance of the business, and if he can't bring in cash due to the fact that he's insolvent, then the other partners will have to bring in cash in order to pay off for him. This rule is what we call the Ghana versus Murray rule. The Ghana versus Murray rule. It states that if a partner is insolvent and cannot bring in cash when it's required, the other solvent partner will have to pay for those debts as regards the ratio of their fixed capital account. Okay, as regards the ratio of the fixed capital account. Okay, that's what it states. So that is how to prepare it, and these are the accounting entries. So we are going to see a question. Now we're going to see a question on different aspects, because this dissolution have different stages. Now we're going to see a question. Now we are going to see a question on the first one: profit on dissolution. That is when there's profit or dissolution, how do they treat it? Okay, and the second one is loss on dissolution. That's what we are going to see questions on. If there is loss, how is it treated? While the third one, loss on dissolution, necessitating partners to bring in cash. Now there are times whereby they incur loss and they are required to bring in cash to pay off their debt. How is it treated? While the fourth one is when partners take over assets and liabilities. Okay, while the fifth one is sales of business for shares. Okay, these are the 5 scenario and situation whereby we're going to see question based on this dissolution. When there's profit on dissolution, when there's loss on dissolution, when there's loss on dissolution necessitating partner to bring in cash, when partner take over asset and liability, and sales of business for shares. Now let's see the question. Ensure you've given me a like and comment and share this video. Now let's see the question. Don't go anywhere. Now let's see the question. It is when profit is made on dissolution. And the question said, Joy and Gad trading in partnership agreed to dissolve the partnership on 31st December 1997. The balance sheet as at that date was as follows. Now we have on the debit side, on the left hand side, capital, Joy 10,000, Gad 20,000, which sum up to be 30,000. Current liability, creditors, which sum up to be 15,000, all sum up to be 45,000. Now we have plant and machinery 10,000, furniture and fitting 5,500, stock 4,500, debtors 12,000, cash 13,000, all sum up to be 45,000. Now I said the profit and losses are to be shared equally. The sundry debtors realized 11,000, plant and machinery 12,000, stock 7,000, furniture and fitting 5,000. The cost of dissolution was 500 naira, and the creditors were settled with 12,000 naira. Required, prepare the necessary accounts for dissolution. Okay, so they have asked us to prepare the necessary account for dissolution. Now the first thing we have to prepare, first one we're going to prepare is the what? Realization account. Okay, so the name of the owners, they said is what? Joy and Gad. Okay, so I'm going to prepare the realization account. So we have the realization account. Now remember, in the realization account, we said the debit side will be the book value of asset. The book value of what? Asset. Now they gave us a balance sheet. So we are going to write the book value of the asset except cash. Remember, we said except what? Cash. So the first one there, as you can see, is what? The plant and machinery. So we have the plant and machinery. How much is it? 10,000. So that's what you start with. The next one there is what? The furniture and what? Fittings. So we have furniture and fittings. How much is it? 5,500. The next one there is what? Stock. A stock. How much is it? 4,500. The next one there is what? Debtors. Debtors, which is how much? 12,000. Okay. Now, why the next one is cash, which is 13,000, but it will not come in the what? Book value of asset in the realization account. We said it. Okay. So instead of we'll put that in the cash book, in the cash book. In the cash book, we can put it there as balance brought forward. How much is there? The cash? 13,000. Okay, so that is that's the book value of asset. Now the next thing we're going to check, let's check in the additional information. They said the profit or loss are to be shared equally. Now they said the sundry debtors realized. Now let's write down the cash that was realized. Okay, the cash that was realized. So we'll say here, cash realized. Okay, the cash realized. The first one there is debtors. So write debtors. Debtors is how much? 11,000. 11,000. So the corresponding entry, remember I said when cash is realized, you credit the realization account and you debit the what? The cash book. So I'm going to put the corresponding entry immediately. So we'll come here. Cash realized. The first one is debtors. How much is it? 11,000. Okay. Now the next one, they said plant and machinery 12,000. So we put here plant and machinery 12,000. Come here, plant and machinery 12,000. Okay. Now the next one, you check stock 7,000. So you come here. These are the cash realized 7,000. You come here, stock 7,000. Okay. The next one, they say furniture and fittings 5,000. Okay. So you come here, furniture and fittings 5,000. Now you come here, furniture and fittings 5,000. Okay. Now the next one, they said the cost of dissolution was 500. Remember when we said the cost of dissolution, that the expense they incurred in dissolving the partnership business. Now we said it will be credited as being paid and you debit it to the book value of the asset. So we'll have dissolution cost. That's all right. It the income cost. How much is it? Dissolution cost there is 500. So I have 500. So we'll come here, right? Dissolution cost in the cash book as what? 500. Okay. So the next one, they said, and the creditors were settled with 12,000. Now, remember I said this while I was explaining in terms of discount received. They said the creditors were settled with what? 12,000. Now let's check the balance sheet that was given. In the current liability side, you saw creditors there as what? 15,000. And they said they were settled with 12,000. He said they did not mention discount received, but you should know that if they settle them in full as that, now the remaining balance becomes discount received. Take note. So if they say they settle them with 12,000, so we'll come here. Remember, if they settled them with 12,000, if they settle creditor with 12,000, you credit the cash book 12,000. Now the corresponding entry will go to the creditor's account. Now if we have a creditor account, the creditor's account. Now in the creditor's account, remember, let's write the book value of the asset. Remember in the balance sheet, our creditor was given there how much? 15,000. So write it, the balance brought forward 15,000. Creditor have a credit balance. Okay. Now they say they paid creditor 12,000. So we're going to write here creditor as cash 12,000. Okay. So if they pay 12,000, if the original amount is 15,000 and they say they paid in full 12,000, it means 3,000 was discount received. I'll say when discount received happen, you debit the creditor account and you credit the what? Realization. Remember? So we'll have discount receive 3,000 and debit here as realization 3,000. So if we add everything, this is giving us 15,000 and this will give us 15,000. So we have closed this. So we have balanced it for the creditor. Okay. So we'll continue. Now we'll check the question also. I'll check the question also in the balance sheet. Now we'll see there. Let's prepare the capital account. The capital account. So if we do that, okay, for the capital account now, we have joy and guard. We have joy and God. Now, if you check in the balance sheet, you'll see a capital that is there in the capital account. For joy is 10,000. That's a balance brought forward. 10,000. And for God is 20,000. Okay. So from the capital accounts now let's now write the individual accounts. Open the individual accounts of this. We have the plant and machinery. The plant and machinery. From the balance sheet, if you check there, asset have a debit balance. So the balance brought forward for plant and machinery is 10,000. Okay. And the next one is furniture and fitting. Furniture and fittings. Also from the balance sheet that was given, the book balance, the balance brought forward for furniture and fitting is 5,500. Okay. Also for stock, the balance brought forward, they are all assets, they have debit balance is 4,500. And for debtors, the balance brought forward also is what? 12,000. Okay. Now let's now determine if there is profit or loss. Now the only account that can determine if there is profit or loss is the realization account. Like I said before, if the credit side is greater than the debit side, means there is profit and you share according to the profit or loss sharing ratio. But if the debit is greater than the credit, it means there's a loss. Okay, so be that. Now I'm going to add. Now let's add the credit side. Now we have 11,000 plus 12,000 plus 7,000 plus 5,000 plus 3,000 will give us 38,000. 38,000. Now let's check the debit side. We have 10,000 plus 5,500 plus 4,500 plus 12,000 plus 500. Now that is 32,500. Means the credit side is greater. It means there's a profit. Okay, so we're going to get a profit. So we'll have what we call the share of profit. And from the question, they say they share profit or loss equally. So we'll have for joy and for God. Okay, now first, this side is 32,500. Deducting it from minus 38,000, you have 5,500. Okay, so now 5,500 is a profit. So this is 38,000. So it means we are going to share it between them. So it will be 1/2 times 5,500. That's half. 5,500. Okay, so if we do that, you have 2,750 and 2,750. So when we add, we have 5,500. Okay, so that is the profit, 2,750. Now this profit now will now be transferred to their capital account. Okay, so you now have here a share of profit. Please follow me. So for joy, it is 2,750. For God, it is 2,750. Okay, so they will now have to add it. 10,000 plus this will give us 12,750. And 20,000 plus this will give us 22,750. So there is no other item here. They didn't take any asset. So the balancing figure, remember, I've said the balancing figure will not be balance carrier, it will be cash because it will be paid from here. It means what is there as the balancing figure must reflect what will be the balancing figure for cash. So it will be cash as 12,750 and this as 22,750. Okay, so that's 12,750 and 22,750. Okay, for the cash. Now let's now add this. So since it is debit here, the corresponding entry comes here as credit. So it will be cash now. Cash for joy 12,750, and for God it is 22,750. So when you add together, you now have 12,750 plus 22,750 into 750. That is 35,500. 35,500. So that when we add everything now, it should balance automatically on its own. Okay, so 35,500 plus 12,000 and plus 500. So we have 48,000 here. And if you add all this also, 13,000 plus 11 plus 12 plus 7 plus 5 equals 48,000. Now that will show you that what we did is right. Okay, you see there is no balance carried down anywhere, so it balanced itself, showing that the balance here and the balance here merge. It means that the business will be paying them this amount as cash and they will be receiving it. Okay, so we close this account also. These are the balance brought forward. Now reflecting this now, plant and machinery, we debited the book value here, so the corresponding entry will come here. So it will be realization 10,000, and that will close it. And this other one also, realization 5,500. And this other one, stock, realization 4,500. And this debtors, realization 12,000. Okay, so that balanced the accounts automatically. So that's how to prepare a realization account. Now this is when profit is made. You see when profit is made. Okay, we're going to see when loss is made, and also when loss necessitating the partners to bring in cash, and also when they take over, when the partners take over the asset of the business, and also the sale of business for shares. We're going to see that. So ensure you follow us on this series. Don't miss out. And the only way not to miss out is that you subscribe on the notification bell so you know when we drop this. Okay, and also drop a comment asking relevant questions on this that you are not getting, and we'll drop that for you. Okay, thank you very much. Ensure you like this video and share also to your classmates. Now I want to recommend a video for you that you have to watch. Okay, now you see this video, it will help you understand this. Watch it now, it will help you. Thank you very much.